As an asymmetric investor looking for those stocks that are going to potentially 10x over the next 10 years, I'm always on the lookout for hyper growth stocks. And there are two that I think investors need to pay more attention to. One is a company that you probably know, that is Spotify. The company is growing its user base extremely quickly, but let's consider that they're going to increase their prices starting in the fourth quarter. That'll start to impact their financials. And their advertising business, I think, is just getting started. So I'm going to dig into that company and why I like it long term. And then On Holding is the other one. This is a company that if you aren't familiar with their shoes and their apparel, they're really a powerhouse in the running business, and they have had a ton of growth, a 65% compound annual growth rate over the last 3 years. So I'm going to dig into these two stocks, why I like them so much. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And let's start with looking at a few of the metrics for Spotify, because I think this is where it gets really impressive for the company. This chart is a look at Spotify's subscriber base. The blue columns are Spotify's premium subscribers. These are the people that are paying $12 a month for the premium service. That would be the US price, and different prices around the world. And then the orange column is the ad-supported tier. These are the people who aren't necessarily paying anything, but Spotify is generating revenue from advertisements from them. So you can see that the company's growth has just been really tremendous over the last 5 years, but it's actually picking up. The last couple of quarters, Spotify has not been impacted negatively by the end of the pandemic, like I think a lot of us thought. They've actually been growing faster, in excess of 20% year over year. They already have a 500 million users. They're on the path to having 1 billion users in the next 2 to 3 years if this growth rate keeps up. The challenge for Spotify has always been the company's margins. You can see the green column is the premium gross profit. And the way that this works is you pay your monthly bill to Spotify. They're going to share about 70% of that revenue with the record labels, and then they keep 30%. That's what they need to cover their operating costs. But that doesn't lead to a particularly profitable business. Typically, tech companies are going to have higher than a 25 to 30% gross margin. They're going to have more like 40 to 70% gross margin. So that's really why Spotify has not been extremely profitable. The ad-supported tier is where we should see a little bit better margins, but you can see that that has not materialized in really any way. And one of the reasons for that is the ad tier includes costs related to podcasts. Podcasts have been a growth avenue for Spotify because they've been able to attract more users, but it's been very costly because they've acquired a bunch of exclusive content, things like Joe Rogan. There was the Obama podcast, and they haven't really paid off in the way that the company would hope. So the costs going here, that's why you see margins being so low, despite revenue growing a little bit over time, maybe not as impressive as we might think. But this is where we get to the point where I think we need to be bullish about Spotify's future. If you listen to Spotify, you probably noticed in just the last few months, the company's targeting of advertisements is getting better. On top of that, the company is one of the leaders in audio artificial intelligence. So they have the AI DJ. That's something that has been incorporated in Spotify for a little while now. But they have talked for months now about rolling out AI-powered advertising. So this would be things like a local hardware store being able to have a celebrity read an advertisement because it's actually an AI reading it, and then you can target that advertisement locally. That should allow Spotify to increase the advertising revenue, and the reduction in costs related to the cost cuts from lower podcast spending should allow those margins to increase. So I think you have a number of growth vectors here for Spotify. You have increased prices, the number of subscribers is increasing, and we're going to see monetization from that advertising business get better and better over the next few years. So this has been a growth company in the past, hasn't quite been as profitable, but I think long-term, we're going to see Spotify continue to grow that revenue, potentially 20% per year over the next 5 years. And if it can do that, and if it can do it profitably, this will be a phenomenal stock. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The second company is On Holding. If you're not familiar with On Holding, they make shoes. It's a high-end product, typically geared towards either athletes who are looking for a specific kind of shoe, like runners. They're now getting into tennis, or kind of that high-end fashion segment. The shoes are not cheap. They're in excess of $140 in a lot of cases. So this is not going to be your discount shoe that somebody's just going to walk around with. But high-end shoppers who are looking for a little bit more style or maybe cachet than a brand that has a little bit bigger footprint than On. You're seeing that a lot more. And that's where the company has gained a ton of traction. And the growth numbers are just phenomenal for On Holding. This is the chart, shows revenues in black, gross profit in blue, and net income in orange. You can see that revenue number up nearly 4x between December 2020 and September 2023. This is a trailing 12-month chart. Gross margins have just been tremendous. The company is projecting the gross margins are going to stay around 60%. So if they can maintain that, that will be a phenomenal business. And net income is positive. This is something that's really surprising when you consider that it's really hard to make money on a hard goods product like this as when you're growing as quickly as On is. You have to build inventory, you have to build out a sales team, you're spending more and more on operating expenses and capital expenses. So typically it's a negative cash flow business, at least short term, and then it's long term where you're looking for that growth to actually start to impact the bottom line. But On Holding has been able to grow and report positive net income because of those extremely high margins. So I think this is a phenomenal sign. You can see that the compound annual growth rate or the revenue growth rate long-term for On Holding of 66%. Now that's not going to maintain forever, but the fact that they're growing that quickly is incredibly impressive. Management is expecting growth of about 30% for the next 3 years. If that happens, I think this will be a phenomenal stock. And the other thing to keep in mind is the valuation. The enterprise value to sales ratio as I'm recording is 3.5. The next 12-month price to earnings ratio is 36. If we compare that to Nike, which I think you would consider its biggest competitor, the enterprise value to sales is 3.1 at Nike, and the next 12-month price to earnings ratio is 28. So On Holding slightly more expensive than Nike, but a much, much faster growing company, much better margins. I don't see those things subsiding anytime soon. So if you are an investor who is willing to buy a stock and hold it for the next 5 to 10 years, I think you can just expect On Holdings to continue growing. They have had phenomenal execution. You can see those numbers are really hard to disagree with. That this is a hyper growth stock, and that will likely continue for the foreseeable future. So to recap, I went over Spotify, why I like the company's user growth and revenue growth, both on the premium and advertising side. I think those advertising margins are really the thing I'm going to watch over the next couple of years. And then On Holding, one of the best growth companies in the consumer goods space right now, 66% CAGR. If they're even able to grow over 20% per year over the next 5 to 10 years, that is the kind of performance that you need to have a 10x stock. So I think On Holdings fits that bill. What do you think about Spotify and On Holding? Leave your comments in the comment section below. Thanks for watching, everybody. I'll see you here next time.